Tuesday morning, you open your phone, $2.5 trillion. Gone in just 72 hours. Not slowly, not gradually. Gone in the time it takes to watch a movie. Headlines are screaming, news anchors are cutting into programming. Your feed is flooded with the same question over and over. What just happened? And the answer everyone gives you is the same. The war, the tension, the news. And yes, there was a geopolitical event. Real conflict, real uncertainty. That part is true. But here's what nobody on television is actually telling you. The news didn't crash the market. The news was just the starting pistol for something that was already loaded and ready to fire. What you watched over those 3 days wasn't a crash. This was a transfer. And understanding the difference between those two words, that's worth more than anything else you'll read this week. Here's the first thing you need to understand. The market is not one thing. It's not a single organism that reads the news and reacts. It's a battlefield, different players, different speeds, different goals, completely different amounts of information. And when something big breaks in the world, those players don't all move at once. They move in sequence, in a very specific order, every single time. And this is where things start to break, because the first move doesn't come from panic. The moment a major geopolitical event hits, the very first thing that shifts isn't stock prices, it's uncertainty. Modern finance runs on models, pricing, risk, forecasts. And when uncertainty spikes, those models stop making sense. Nobody trusts the outputs anymore. And when you don't trust your model, you reduce your exposure fast. So the first move is quiet. The giant funds, pension funds, sovereign wealth funds, hedge funds managing hundreds of billions, they start repositioning, slowly, carefully. They rotate. They move capital into what the financial world calls safe haven assets, treasury bonds, gold, the Swiss franc, instruments that hold value when everything else is unstable. Not because they're magical, but because enough people believe they will, and belief, at scale, becomes reality. Watch what happens next. These institutions can't move fast. If you're managing a $400 billion fund and you try to sell $20 billion of equities too quickly, you crash the very prices you're trying to exit. So they use algorithms, dark pools, gradual execution, invisible to most people. But the market still notices. Volume patterns shift. Certain sectors start quietly underperforming. The experienced eye sees it, not in the headlines, but in the behavior of money itself. Then comes the second wave. Mid-sized funds, smaller trading desks, professional investors who see the pattern and start moving their own positions. Now selling becomes visible. The indices start ticking down, not dramatically, but consistently. And this is where you enter the picture. This is the part nobody tells you. You open your app, down 6%. You refresh, down 8, then 10. This isn't data anymore. It's stress. Here's the thing about that moment, and this is the part that really matters. Your brain is not built for this. Loss aversion is a real, documented cognitive phenomenon, and it works like this. Losing $1 hurts twice as much as gaining that same dollar feels good. Double, asymmetric, wired into your biology. So when you see that number dropping, you don't think, let me analyze the underlying fundamentals of my positions. You think, I need to stop this. And you sell. And this is where you lose money. Here's what makes it worse. By the time you sell, the institutions already moved. The smart money repositioned while the news was breaking. You are reacting to the effect of their movement, not the cause. You are the third wave, and you are always last. By the time you react, it's already over.
And it gets worse still. As prices fall, margin calls get triggered. Investors who borrowed money to buy stocks are forced to sell, not because they want to, but because their broker requires it. Forced selling pushes prices down further, which triggers more margin calls, which creates even more selling. The original news event may not even change, but the market keeps moving, driven now by its own internal mechanics, a machine that set itself in motion and cannot stop. Now, the question everyone asks, but nobody fully answers: where did $2.5 trillion go? Here's the truth, in plain language: it didn't go anywhere. When a stock drops from $180 to $140, that $40 doesn't disappear into a vault somewhere. It represents a change in agreed value, what buyers and sellers decided that piece of ownership is worth in that moment. The capital that rotated out of stocks moved somewhere else. It became the Treasury bond price increase nobody reported on. It became the gold rally. It became the dollar strengthening. Money doesn't disappear, it just changes hands. The financial system is a closed circuit, and the moment you truly understand that, you will never read a market headline the same way again. So what does this mean for you? No prediction, no recommendation, just a framework. The next time you see a headline telling you the market is collapsing, pause before you react. Don't ask, "Is this bad?" Ask, "Where is the money going?" Because it's always going somewhere. The institutions know this. They've studied retail behavior during stress events for decades. Their models include assumptions about your reaction. The quiet repositioning, the gradual decline, the panic selling, the price overshoot, that entire sequence is not a surprise to the people running $10 billion portfolios. In many cases, it's exactly what they were waiting for. That's not a conspiracy. That's just how information asymmetry works inside a system that rewards the calm and punishes the reactive. That $2.5 trillion you watched disappear on Tuesday morning, it didn't vanish. It moved. The market didn't break this week. You just saw the system working exactly as designed.